now where do I find a person who is not involved in the commission structure as much, but involved into what's right for me? And that's what I wanted to provide to people, that okay, based on your scenario, because everyone's scenario is different, I could do that for you. And I'll give you an example. The 5.75% I talked about this company in last year, it might seem like, I'm getting 5% or plus in my money market account. Well, it was 5.75% even 2 years back when the banks were giving us a less than a percent. So not only it has the consistent, it does not have that fluctuation of the banking environment. It does not have the fluctuation of the banks itself, because we can see 2008 and even now there are bank failures happening. The insurance company, they have been going way back and they don't fail. So that's the reason why we want to create this structure for your hard-earned money with the mutual companies. I hope that makes sense.
No, it makes sense, and I want to kind of talk about the importance of this being individualized, because I know you mentioned about using whole life to set it up. I personally set it up with a VUL, but there was a very clear intent behind that. I think if somebody wants to set it up such that they can use it as sort of quote unquote retirement money, which is growing passively, and then they can draw against it, use it whenever they want to use it, maybe one-off investments. I think that's a very different strategy, and there's going to be a very different approach of setting infinite banking up for that. Whereas for me, it was very clear that when I set it up, I want to make sure that every dollar that I draw from my insurance in the future is going to get invested somewhere. So there's a delta that I want to create. Either it's in starting a new business, either it's starting a new venture, either it's investing in real estate or whatever have you, but I want to have that invested in a particular asset that I control, not invested in stock market or anything. And that's the reason why I set it up as a VUL, because I'm not necessarily looking for that safety net or that guarantee, because I'm betting on myself essentially, because I think if my insurance does well, and I'm betting on the stock market, if the stock market does well, my insurance does well, I have this cash value which I can kind of take out and diversify that cash into other avenues that I'm working on. And that's the reason why I set it up, and that's why I said it has to be individualized to the person that's setting it up. It cannot necessarily, it's not one size fits all. If you're a busy professional working in your job, you really don't have the bandwidth to talk about other things, think about other things, talk about other things. I think whole life is a great way to go setting up infinite banking, because, further down the line, when you have more time at hand, you have more surety of what you're doing, how you're setting things up, then you have this huge, chunk of money lying around that you can invest into other things. But when you're, if you have the time to kind of and the bandwidth to set up new things for yourself. For me personally, I think VUL would be a better way, because it really accelerates the way you grow. Sure, there is risk attached to it. And sometimes it also depends on how risk averse you are, right? For example, whole life, there's literally no risk there, because you're going to get a guaranteed X% return compounding year on year. For an indexed universal life, it's kind of like, the way I look at it is it's in between VUL and IUL. Indexed universal life, there's a floor that's zero. So if the stock market goes below that, you're still hitting zero. You're not going negative. But if it goes positive, there's a cap. Of course, there's a ceiling. If it goes beyond that ceiling, you hit that cap. But VUL fully participates in the stock market. And for me, I bet on the American economy, and so I wanted to invest fully in the American economy. And so that's why I set it up like that. But beyond this, let's talk about the next steps, because a lot of times, like you had mentioned, when we're setting up our life insurance, there is a death benefit and then there's a cash value. And really what we're trying to do is really maximize the cash value rather than the death benefit. Traditionally, the way life insurance is set up is having a very high death benefit and a lower cash value, which kind of builds a drag on it. Let's talk about that now.
Absolutely, absolutely. And I'm just going to mention a little bit that what you talked about. Yes, it's not a one size fit all, but if you look at the infinite banking, kind of the concept, how Nelson Nash talks about it, It's based on the whole life, and that's because of that guaranteed portion,
Right,
that kind
right.
of the safety, that kind of a foundational principle. When
Absolutely.
you are implementing something for your life, and if you don't have anything, the first, I mean, you can have multiple life insurance strategies in your kind of a financial structure, right? So I look at it, when you're going up in that pyramid, that the IULs and VULs could be on the top of it using life insurance. But the foundational, the infinite banking, the
Right.
way it's supposed to be structured is with the whole life. Now, if you
Yes.
create that first one, which is replacing your saving strategy, not investing strategy, you create that with the infinite banking, with the whole life. And now as you go up and you want to replace your investing strategies, whether it's real estate, whether it's IUL, and still have that life insurance component to it, because believe it or not, as we go up, our net worth is going to go up, so our capability of getting more life insurance increases. So now it could be the second strategy or third strategy, but at least one strategy having
Right.
that guaranteed growth and kind of risk managed, or zero risk actually, is really, really important. So now
Yeah.
let's talk about the steps the question that you asked, right?
Right.
So typical life insurance, the way it works, that 100% premium, and I will go back to my previous example, the 7,000, say, buying you $1 million death benefit, right? The 100% premium goes towards the death benefit, right? And that's why
Right.
the early years, the cash value is zero sitting in there, right? And in infinite banking structure, however, we can slash that cost. So the cost of death benefit, the moment you make it less, it can have a capacity of sitting that cash on the top of that system, right? So say, for example, if we slash it down to a third or a fourth of the death benefit, right? So if, for example, instead of buying you $1 million death benefit, if we buy it's just 250K death benefit, it might not be sufficient in many cases, but just an example, let's go with that. So now you can put that certain amount of money in there, say 5-6 thousand as a minimum, but now you can add, say, 20,000, 10, 15,000, whatever that range allows you, and now you can put, say, 20,000 altogether in that system. Now next year, when when the insurance company is going to provide the dividend, they're going to see that cash value sitting in there. So there is at least the 3/4 or 2/3 cash value just sitting in there. That's when you're going to start getting that dividend. Every year that dividend goes up, and this is growing inside tax-free environment. So you're
Right.
not paying taxes on this growth every year. So that's really, really important to understand. It's growing tax free, and as you are mentioning, whenever you want to access from it, now you can take a loan from it, because remember the second principle, uninterrupted compounding. So you're adding to it, the dividend is rolling in and adding it to the principal. Now the dividend is the now the cash value is becoming bigger and bigger, and you're getting dividend 10-15 years down the line. That's when it starts hitting that exponential curve, and now you're getting more dividend every year, more than possibly that the premium that you're adding to this system. So that starts actually happening in there. It can go to a stage where it can self-sustain, that you can stop paying into it. We can structure it that way too. But now you're going to taking the leverage. And now the way I look at it, right, instead of me doing the savings and investing both inside the life insurance, either with VUL or with IUL, now I'm taking the leverage and putting into, say, real estate, which is more risk managed. So I'm still not taking, that risk on the investment side as well, but at the same time, not compromising the growth too, because real estate, as you know, can provide 15%, 20% annualized returns as well. So now I'm taking this money, putting into the real estate. Inside this system, now you can utilize this money for multiple purposes. You can save it, you can utilize it for investing purposes, like I just mentioned. Now, if your kids come to an age where it's education is required, now you can use it for education. By the way, the life insurance money, which it's inside, when you go to and fill out those FAFSA forms, and listeners, if you don't know what FAFSA is, that's a system that you will put in the what your net assets are, what your income is, and it basically provides colleges a number which they determine based on what is the need that they have. Will they get some certain scholarships, certain grants, etc. the life insurance money, the cash inside it, that is not accounted for in FAFSA form. There is no space for it to enter it, right? So if they're gonna get the grants or scholarship, this money is not gonna impact that. So now you can utilize it for your college education for your kids. Unlike 529 plan, if you have now leftover money and they did not utilize whatever you were planning for it, now you can again continue investing and growing it, and now you can put it into your retirement. So you can start drawing retirement income from it, right? So in your case, the VUL that's driving your retirement income, you can supplement the retirement income with this, because what happens is, imagine 2008 people were retiring at 2008, their retirement account got slashed 30-40%. They still needed money to take it out. They took it out pennies on the dollar. What if they had a second bucket which they can buffer against for those years, and it came back in few years, right? In those years, if they had this second bucket, they wouldn't have taken those pennies on the dollar. So in your case, when you have VUL and the VUL needs that 1 year of slump and it just needs to be supported by something else, you come back here, you take your retirement income from here. In 2 years it goes back, and now you take the retirement income from there and continues to do that. Whenever you have those slumps in the stock market or your investing strategy, you take it from here. So this is how you can actually layer it and use it for multiple purposes. Little bit advanced strategies, didn't mean to go there to
No,
have our listeners confused, but I loved what you have done, and I'm just kind of bring that to you, saying that how now you can create this like a led strategy in your case.
no, I love that. And I think the reason why I wanted to go into this discussion was because it kind of sheds some light on the nuances of this and the importance of working with somebody who knows about it. I mean, certainly
Yep.
people can talk to other people who are actually setting it up the right way. And otherwise, you can go online and, you mentioned Ansar Nash. So for listeners, he was the person who actually devised the concept of infinite banking. And like you said, he started with whole life insurance because I think it's about having that base stability or surety of guaranteed returns and then doing anything else with the money. Again, it's all about what fits your style of investing, what fits your style of saving money. So it's never going to be one size fits all. But Madhavi, let's talk about some of the misconceptions that people have had when they've talked to you about infinite banking, and how did you kind of explain the stuff to them?
Uh, Great question, Avishkar. So I see top three reasons that people, and it's really disheartening to see that at least 80-90% people I meet, they haven't implemented infinite banking system. And the top three reason that I see is, number one reason, that they don't understand it. They think it's too complex. Now you have taken that time to kind of understand, see what works in your scenario, and I completely agree with you. Everybody's scenario is different, and I try to look at what they want to do with it and how we can help, right? So that structuring is really, really important. But before that, the education is really, really important, which is I'm really, really passionate about. So a that they don't understand it, they're confused about, and I would say that real estate, understanding a multifamily underwriting, is more complex than infinite banking structure
Right.
actually. But yet there are these syndicators, investors in multifamily, they just say that, oh, I just don't understand it. It's not, it's too complex. So that's one thing. It's not a misconception per se, but it's kind of that mind block almost, that this is too complex. I will do this when I have time because I need time to understand it. So that's what I always challenge, that got to start somewhere, start taking that baby step to understand it and see how it fits in. Because as I said, that this is not just about achieving that high growth, or what's your financial freedom is going to be, but this is about growing, preserving, protecting, and passing your generational wealth. So if you don't start that step of
Right.
understanding it right
Right.
now, this is just a loss. I mean, you will lose all this bigger perspective. The second misconception I quite often hear is that it takes time. Did you hear? Did you thought that way? That did you think that it takes time?
Well, I think it really depends on who you're talking to, right? So, because when I spoke to one of the insurance agents, and they were like, "Oh, it's going to take 10 years, 12 years to set it up," and I had to actually explain to them, "No, I don't want it set it up like that. I want it to be set up
Right.
so that I can front load the insurance policy, so that it
Absolutely.
doesn't take that much time."
Yeah, so you kind of answered that misconception yourself, Avishkar. Kudos. So that's what it is. So understanding, and I mean, this is definitely a long game plan. This is your long-term strategy. But does
Right,
that mean that you can't access it? No, because if you front load that money, say if you push that 100K in the first year and you have certain amount of money that's available to you, so literally you can set it up. And if you say want to access say 50,000, 60,000 from it in week one, you can literally start accessing. You can,
exactly.
either go to the life insurance company themselves to get that leverage from it, or you can even go to third party companies, right? So these are no questions asked because you have the money there. It's collateral for you.
Right,
There is no origination cost. There is no credit check that's done. And by the way, if you take the leverage, say, if you have $1 million in there and you have 500K leveraged out, and say your death benefit is sitting at 2 million or something, and if you never pay that 500K, what happens is at the death, the 2 million minus 500K, the loan payoff happens from the life insurance money, and the 1.5 gets, handed over to the heirs. So this is
right,
really important to know. And let me just step back and talk about in terms of how the 401ks work, right? We put it the tax, before the tax money there, we save on some
right,
taxes, but whenever you get taking that dollar out from retirement account, it's gonna be taxed. Whether
right,
you take it out or whether your heirs take it out, right?
right,
In the life insurance bucket, this is growing tax free. You access from it when you're alive, live your life insurance using the leverage strategy. You pay
right,
the interest rate, but you're not paying the taxes on it. And if you have that outstanding, it's going to pay it off, and the remaining amount goes as an income tax free death benefit. It will still have the federal tax exempt kind of limits. There are
right,
certain strategies you can do about that too, but this money is basically floating in the system tax free. You have created based on whatever limit that you want to create. You can access anytime that you want. So now you have a system that's growing per your need. You're using it for any purpose anytime. If you decide that I want to retire at 55, I want to start taking my retirement income at 55, and you have sufficient money there, nobody's going to stop you from doing that. Unlike your 401k, you have to be certain age, right?
right,
So
right.
now you can build without any restriction, access without any restriction, and pass it income tax free to your next generation. So that's the beauty of this.
Amazing, amazing. And how does it tie into commercial real estate that you and I are kind of operating in that space? How do you tie it to investors who are investing in that space?
I love that. I describe it as how the train tracks are. They go parallel, parallel, parallel for the long time, and they meet and they kind of go parallel again, right? That's exactly what happens. You can do the real estate independently, or you can do the infinite banking independently. But here is where the overlap happens. If you start funding your infinite banking system and it reaches to a point where your emergency saving has been crossed. So say for example, your sleep well money, as I call it, is say 30,000 or 40,000. And what is that your family's expenses for 3 to 6 months, for example, right? Now, if your money goes beyond that and you have 80,000 in there, so now that 50,000 becomes the opportunity money. Now you can leverage from it. So now you can leverage either, like I was saying, from the insurance company or the third party. Access it is interest only, right? So you're just paying interest. For example, if you now get a real estate deal which is giving you say 8% cash on cash while its whole period, and when it's at the end of that 3 to 5 year term, it's going to give you that 2x return or something like that. So now you can take this money, borrow from it, not take it out, because remember, we don't want to interrupt that compounding. So borrow from it. So when you use this 50,000 from somebody else, just like a home equity loan or something like that, if you had 80,000 inside the system, it's still 80,000. It did not go to 30,000. Okay. You take the 50,000 from somebody else at that interest only payment or whatever payment that you want to set up, you comfortable with. You put it into real estate investment in the syndication now. That syndication starts paying you 8% cash on cash. You utilize that 5, 7, 5%, 6%, whatever, to pay that interest only portion of that money that you borrowed. The money inside is still getting that dividend and it's earning you compounded interest, right? So now you took the same dollar and used it at two different places, right? It's saving for you, compounding for you, and it's investing. At the end of that 3 to 5 years, now if you have your money back, if you want, you can pay it back and take care of that loan, or you can invest into kind of repurpose it into another investment. And typically, I don't know about you, but this is what happens with me when I come out of an investment. There is kind of a lull period where there's like a 1 or 2 months where I'm looking at other investments, doing my due diligence, and then I'm ready to put into it. It doesn't time perfectly that, okay, I'm exiting on one investment and the second investment is almost ready for me.
Right, right.
So now you can replenish that, you pay off your loan. Whenever you're ready to do that again, it's rinse and repeat. So that's how the two paths kind of meet and again can separate and meet and separate again. So that's a twofold approach. We think outside the stocks. I say it that you savings is your first layer to it. As the saving goes beyond the savings, the emergency fund, to the opportunity dollars, now
Right.
you can fund your investments, use the cash flow from investments to make your foundational bigger and better as you go in, and you keep on doubling your money, whatever that 3 to 5 years, at the so small cost of the interest only portion that you have it. So that's the beauty of it. It's called an and asset for a reason, because you can utilize the same dollar at two different purposes.
Right, absolutely. Well, Madhavi, it was really fun talking to you today. And how can people reach you if they want to kind of set it up? Because I know it's sort of nuanced, and you really need to understand the other person's situation, what their financial health looks like, what their goals are
Absolutely.
like. So how can people reach you if they want to get something set up?
Thank you so much, Avishkar. So thinkoutsideTheStocks.com, that's my website. Check it out. If you want to schedule a call for me, you can go there. Or if you want to, jump into I have a thing to offer. I can offer a 1 hour free strategy session to your listeners today. And if you want to, get that free strategy session and see how it really can impact your own scenario, because everybody's scenario is different. So you can go to bit.ly/infinite call, all one word, in infinite call, and you can just schedule that strategy session with me. And I would love to know what your goals are, what you want to do with, and how we can make it flexible in your case. So I think that's how you can get in touch with me. And I really, really enjoyed this conversation with you. You have brilliant questions, brilliant flow, and I hope I could add a little bit more value to your listeners today.
Amazing. It was fun. It was really fun. I've always had fun talking to you on different occasions that we've discussed other
Yes.
things besides infinite banking. But thank you so much for joining me today and, enlightening our listeners about what infinite banking is and how, they can set it up. And hopefully, some people can gain value from this and, talk to you more about infinite banking. Well, thank you so much for
Absolutely.
joining me. And thank you so much, everybody, for listening in and tuning in. I'll see you all next time.
Thank you so much.
All right, guys, if you haven't done already, please go check out my free video series on how to do due diligence on operators and on deals before investing in them. It's called Real Estate RX for Passive Investors, and it's available at www.rerxcourse.com.